Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you here on this November 11th. We got Barbara Armstrong in the chat. We welcome her and we welcome Kelly, Will, Billy, GH, Elena, Dale Reeves. Go Ducks. So we welcome all of you here. We also got Scott Luck. Aloha back to you. So let's go ahead and get started. So just real quick, today's focus, we will talk about kind of some sectors that are standing out. We do also want to kind of focus on some questions that were asked about management of a caller. And we'll get into that. So kind of half the class will be kind of talking about some new examples. The other half of the class will be talking about management of caller positions. I will also point you towards a video that was actually done so you can see part one of that topic. Now, just real quick, remember that with what we discuss, it's done for informational purposes only. When we talk about, we'll talk about stocks, but we will also bring up options. Remember that options carry a high level of risk and are not suitable for all investors. When we talk about the examples, we will do those on the Paper Money software application, which is provided for educational purposes only. Investing involves risk, including loss of principal. Also remember that past performance is no guarantee of future results. We don't know what tomorrow will bring. And also remember when we talk about short options like covered calls, cash secured puts, if you sell the options, those can be assigned prior to expiration. So have an understanding of what that really means, and is that okay with you? And also remember when we talk about if we bring up, let's say, REITs, understand that there's risk associated. They're similar to direct ownership of real estate, such as changes in real estate values, property taxes, getting into that time of year, interest rates, and so on. So understand that kind of a separate disclosure there for REITs if we look at those. Now, we want to talk about kind of where the market is in general. We do have some things that are kind of shifting a little bit. And I want to kind of talk about maybe some areas that we haven't really looked at maybe as much lately, per se. Now, with that, what we'll do is I want to kind of talk about some positions that have consolidated that might be trying to break out after showing some relative strength. Now, and then after that, what we'll do is we'll talk about those caller management examples that breaks into part two of callers. Now, just real quick, let's pull up, I'm going to pull up this chart. Now, first thing that we notice here is VIX is up quarter of a point, okay? So 1785. We pull it up on the chart. Drastic? No. Below the moving average. We actually closed yesterday. Good. And so it's up a little bit, but it's not up above the moving averages, okay? Another example of rally above 18, some investors consider selling some things in terms of options. You get a kind of a spike on Friday, and then it pushes back down. Now, the one thing that we'll notice is the VIX, it's not like it's going down to 10, which, by the way, historically it would do. Kind of the floor of the volatility that we've been sitting at lately has been about 14-ish. Now remember, if you have a 16 on the VIX, it's about saying that the S&P is moving about 1% from low to high on a daily basis. Okay, so you got to have some volatility. Now, the one thing I do want to kind of point out is Dow Jones holding up a little more stronger than the others so far. We actually got above the 20-period moving average today. We have not seen the color change on the moving average, but the price is above it. The longer we stay above it, that 20-period moving average could go from red to green. Now, if we actually see the Dow Jones actually kind of doing this, we would ask ourselves, what stocks in the Dow are actually showing some strength? We'll come to that because I want to look at a couple. Now, if we take a look at also kind of something that's standing out, we did bring up, let's say, the movement in gold yesterday. And you're going to notice that after the big push yesterday, not much of a give back so far here today. We went up to an intraday high at 4150, and you're going to see that we're actually trading. I mean, remember, if this is zero, okay, this is 100% where we close. We're like still at the top quarter of yesterday's range. A lot of people, they look at the color of the candle and they're like, oh no, it's bearish, it's bearish. Remember, that's a beginner's thought, okay? Red color candles just means it's trading lower than where, or closed below where it opened. But if it's still above the midsection of this big green candle and or that 10-period moving average, the red candle doesn't mean squat, a whole lot. It's just red, okay? Now remember, the red candles are important because those red candles are the formation, the start of what? Higher lows, okay? Because remember, to get a higher low, we need a red candle, green candle side by side. Red candle, green candle side by side. So when we finally get a red candle, how many red candles do we get? 1, 2, 3. And then also, are they able to stay above the shorter term moving averages? If they are, rally potential hope. Now, if we take a look at, let's say, the silver, one thing it looks very much like, you'd actually have to probably say that on the silver, we haven't even really, we're slightly more down on gold. Silver, we're pretty much par for yesterday's close. Continue to keep an eye on those as potential setups. Now, I want to also go to just real quick the sectors, okay? Now, on the left-hand side, if we look at sectors, it's been interesting to really watch the energy smash its way through resistance, okay? Interesting. The one thing you'll kind of notice in looking back, it kind of ran up to resistance, 940-ish, then fell down to the middle, and then kind of couldn't get below the middle. It kind of stuck in there in that midsection. Now, a lot of times you see this where stocks try to break out. Maybe they do break out, they fail, they come back to the middle, knock the bottom of the channel, and then you break out. Now, the one thing to remember is, number one thought when you see that is, go look for an individual stock in the sector. No, that wouldn't be the thought. Number one thought, what's the number one thought when someone actually sees this? Well, the number one thought is, could the investor just buy the energy sector itself? Because that way they're buying the basket. They're at least getting some representation. Now, one of those baskets, not the only one, you know, because we talked about it on Friday. So the number one thought is, could the investor buy the basket? Number two, what are the stocks that are in the basket? Okay. Now, if we said, when you say basket, what do you really mean by that? Well, if I pull up the S&P 500 and if I just went energy, these are the stocks that are in the basket in the S&P 500. You'll notice by market cap, two of these are massive. Exxon, Chevron, okay? And what you're now going to notice other stocks like ConocoPhillips and EOG. I mean, if we're talking about market cap, those are probably the biggest four that we can actually see on the chart. So number one is looking at the sector itself, considering maybe buying the sector. Number two is, are there any stocks in there that are really showing some strength? Now, the comment really came in from Alan as the SLB chart looks like it's breaking out of a 7-month trading range. Alan, what other stocks do you have? I'm joking. Here we go. Now, if we go back to what is Alan saying, Alan is actually saying, if we kind of take a quick peek at that, now, is SLB on my list? Yes, it is. I have HAL and SLB on my sheet. So, Alan, I'm glad you saw it. So when we kind of look at the resistance level, it's trying to break out, and the old bottom of the channel is right there. So let's kind of mark this for just a sec. So we're going to bring up, let's say, energy for just a moment. We're going to kind of mark SLB first. We're going to keep an eye on XOM. And are there any other stocks? I said HAL. Is there anything else? And the one thing we made mention of is we just said the sector itself, okay? There you're buying a group of stocks. Now, the number two, when we talk about, let's say, the movement, we've been kind of talking about the healthcare. And if you look at, let's say, healthcare, this has really been in the ascending triangle. Last week, we kind of said that the patterns are great, but getting into the triangle, up, down, up, down, up, down, ricocheting between support and resistance, not really that great until it breaks out to a certain direction. Now, if we're talking about breakout, not close above, the close above, that was yesterday, okay? We're talking about breakout. The way we define breakout is we want it to open above resistance, close above resistance. So that means the whole body of the candle is above, and it is, okay? So number one, when we talk about the healthcare, the investor might say, I'm going to maybe consider buying the sector, and then maybe, let's say, stocks like what? Type those in the chat, okay? Now, if we went back to this and went Market Watch, we went right back to healthcare and said, what stocks do we have in the list? Now, there's a little small company that we've never heard of before called Lilly. There's another stock in there called AbbVie. There's another stock we never heard of before. That's funny. Called Amgen that are getting a little push. Now, if you said this is blowing my mind, I can't pay attention to that many. Go to the S&P 100. You pull up the S&P 100. What do you get? You get a smaller list. If you say, James, more is not more is less to me, then go to the S&P 100. Okay? Now, so I want to kind of point, now the other one I want to kind of bring up just real quick, one thing that we don't see very often, and why don't we see it very often? Well, number one is when things are reversing back to the upside, we do not normally see trend number twos, and if we do, we don't see them for very long because they either continue to the upside or they break down. That window of trend two is short and narrow. On the staples, trend two. On the basic materials, which shouldn't surprise you with gold and silver, trend two. We actually also see the real estate, trend two. Now, remember, trend two is really what we call a diagonal, diagonal breakout. So on the chart, it's going to look like this, where it's going down, making lower lows, and all of a sudden it comes down, and then it goes like this. So on the bottom, it looks like a W, and then what you're now going to notice is when we say diagonal line of or breakout of resistance, it's breaking through the lower highs if you connect them. If you actually get a trend two, just means you're in between the moving averages of the 10 and the 20 or the 10 and the 30, whatever you use. And this is what we call bullish momentum. Okay. Now, trend two tends to be the start of bull flags. Now, if that stock could actually break out, which it's doing, and for example, make a higher high, the highest chance to make a higher low. You make a high, you break out, you make a higher high, you make a higher low. All of a sudden, you start to get like, hey, it's starting to trend up. But where does it start? Well, before this ever breaks out, like we actually said yesterday, you get those W patterns, right? You get the bullish divergence, which was on a plethora, as Bill would say, many of those stocks that we saw over the last couple of days, and then you get the breakout. So the staples, what do these quickly look like? Well, the staples look like this. They're been beaten down, right? But it's actually showing a little strength. Now, some people, now I'm not making fun of this. I mean, my gosh, I'm 48 myself. But as we get older, we tend to get a mound of cash. And sometimes we say, geez, I don't really need to take a whole lot of risk. I'm just looking for something that might have less volatility, maybe something that actually might have some upside potential, but maybe pays dividends, and the investor tries to get some income. Now, we know dividends are not constant. They can change, etc. But the biggest actually thing is the staples have underperformed. Could they be trying to push back to the upside? Now, remember when we say staples, someone could just buy the group or then look at actually some of the stocks that are in the space. Monster Energy, MNST, correct, is one of those stocks in that space that's showing a little U pattern, okay, pushing to the upside. That is after the earnings. Now, the other one we'll kind of just make mention of, same idea. There's the base materials. Here's real estate. The one I actually have to say with real estate, we said this last week on an X post, there's a number of stocks in, let's say, the REITs that have actually had quite a different performance than the group. Welltower, we actually talked about last week, and you're going to see that if you look at Simon Property Group, that has not completely been horrible in terms of trend, meaning it's not like at a fresh new low. It's not super sideways like the group is. That one actually looks like it's actually trying to get maybe a little bit of a push. You're going to also see that on the longer term, it kind of has like maybe a little shoulder, drop down, right back out to the upside, drop down, run back to the upside. Most of the time, you actually see these after a sell-off, but sometimes you can actually kind of see them maybe in a continuation pattern. Not as common, but it's the same idea. So just kind of keep an eye on SPG just real quick, okay? Now, I want to go back to just, let's say, the Dow stocks for just a moment, okay? If we look at the Dow stocks, just real quick, let's go to quotes. Let's go to the public list. Let's kind of look to do maybe a one or two trades here in looking at the Dow. Now, if we were talking about, let's rank this by percentage change, okay? So percentage change. And what we're now going to notice is one of the stocks that's kind of showing multiple technical indicators green. And that doesn't mean it's going to go up, but the idea is maybe could it? Well, one of them that's kind of showing a little bit here is Apple. And you're going to see that it's in trend 3, okay? It actually is weekly trend 3 on the relative strength compared to the S&P 500 on multiple different durations of time. It's showing relative strength over multiple periods, not just something in the last week or two that's actually been moving to the upside. Brand new hold, and we actually see that the 10-period moving average, the whole moving average, has gone up today. It's the first day that the green moving average, that the line has turned green. So the 10HC, the 10-hole counter, it's showing two things. What is the color of the moving average? That's why there's green and red background, okay? Second, what is the number in the box? The number in the box counts the number of days. The moving average has been green or red. Now, scripts are not guaranteed for accuracy. You want to have an understanding of what that script is trying to show, and then you verify yourself. So if I actually go look and say, what does this 6 mean? Well, the 6 means there's number of days. The moving average has been green. How do you know it's green? Because the background of that box is green, okay? Now, let's go to Apple for just a second real quick. And if we look at Apple, we pull this up. This is one where if I look at this on the weekly chart, okay, you're going to notice that it's been kind of in that little continuation pattern. Now, remember, I want to help you find a newfound appreciation for red candles. Remember, those red candles are at a start, or they can be at a start, of making higher lows. Higher low, higher low, higher low, higher low. I hope that's tattooed in your brain right now. A lot of times, I'm telling you right now, it's going to be hard to ride trends if every time you see a red candle, you run for the hills. Now, why do you say it like that? Because that's what I used to do. I'd see red candles, it would actually give back profit or loss or whatever it was, capital, get pushed down on the overall portfolio. The problem is without those higher lows, you don't make that higher low, which is another confirmation of an uptrend. Okay, breathing. Inhale, exhale. The red candles are the exhale of trend. The green candles, inhaling. Okay, we need both. If you don't think so, well, talk to a doctor. Okay, you're going to need both. Okay, now here's the deal. When we actually go back to, let's say, the daily chart, pull this up, what does this look like? Now, here's the deal. If we look at this chart, why did it show the moving average going green? Well, it just went green yesterday or today. And you're now going to see why is there that green dot? Why is there the green dot there? Well, it's actually, if we look at the lowest, most recent red candle, which was the 7th, it's right there. And you're now going to notice why is that green dot? It's trading above that day's high. There was only one, okay, red candle. Now, the comment is on the RS5 is less than the RS10, decelerating momentum. I'm not really sure if I micro look at it like that. If I went back to this and said, hey, Apple is at a 85.6, and let's say last week it was at 89.7, I mean, I'm really more looking at the colors. Now, if you say, I don't even know what the colors mean, right-click on that, edit formula, and you're going to look and see what does that color represent, okay? So if we get a dark green color, it's just saying the RS rank is above 80. If you scroll down, it's going to tell us what it's compared. It's looking at the stock performance compared to a benchmark, the S&P 500. And if you scroll down, you can see that. I don't look at it like, oh, it's 5 points lower than where it was. Not really looking. I'm just looking at the color. Okay. And so I know, like, if this is 98 and the last week was 100, that doesn't necessarily mean probably the trend's over. Okay. It's a fair question. Just giving you an honest answer. Now, here's what we're going to do. let's say the investor, and we're going to segue into our discussion on these callers. Now, the questions I want to ask you are this, okay? How many of you think in your lifetime you're going to have 100 shares of something? Okay? Pretty good chance. Second, how many of you would actually say, I'm going to have 100 shares eventually of something someday, and I might want to try to get some income off that and maybe do like a cover call? How many of you think you would maybe say, yeah, I feel pretty confident that'd be me? Number one, I'm going to have 100 shares someday. Number two, I might try to get some income on those 100 shares by selling a call, making it a cover call. Okay, fine. How many of you have ever consider one day having 100 shares, but then being concerned about the downside and thinking to yourself, can I maybe have a contractual right to sell the shares at a set price and where the risk is not all the way down to zero? How many of you would actually like to have a risk higher than zero? You might say, James, that's the stupidest question I've ever heard in my life. Well, it's just a question, okay? Now, I think if you ask most people, do you ever think you're going to have more than 100 shares in your lifetime? Yes. Would you ever consider trying to make income on your shares? Yes or no? And then number three, would you ever consider maybe having a right to sell those shares at a higher price than zero? Now, if you said yes to all three of those, that is a caller. Now, historically, when I looked at a caller, I would kind of think about like a leg-in strategy. A leg-in strategy, you're trying to maximize the upside potential. But when you're learning a strategy, it's not necessarily a bad idea to say, look, I'm just going to do a buy right. I don't care if you do a buy right caller. I don't care if you do a leg-in strategy. Both of them are bullish, okay? If we did a buy right strategy of a caller, buy the share, sell the call, buy the put, the biggest actually thing is you're not trying to maximize the gains on the shares. In other words, we're not trying to get the stock to go up. The gains are in the shares and then put on the caller, which might take some more technical expertise. Not that it can't be done, but just when someone's brand new getting started, they might say, I'm not there. The key word is, oh, that's right, yet. Now, if you go to this YouTube page, okay, it's going to show. So if you go to YouTube, type in Trader Talk Schwab Coaching Webcast, if you had subscribed, which it's free, okay, right in the middle of the page, you'll see subscribe. And then right there, you're going to see that there's a little icon right there, caller sample plan. Now, if you just type that in, you're going to see the first thing that comes up is caller sample plan part 1. Now, what happens is over time, some of the videos drop off, okay? So that caller sample plan part 2 is dropped off. But that, if you said, I haven't watched that, I would invite you to watch that, okay? Now, our goal is here, I want to kind of do two of these callers. The caller really has a diagram, risk profile diagram, like a long call vertical and or a short put vertical. This is the maximum gain. This is the maximum loss, right? And that upside, that is what the investor is really trying to get. Now, our focus actually here today is kind of talk about some 2 examples in the management of these positions, okay? Now, let's kind of show this. Let's say the investor came in and they said, look, I want to buy shares of stock, okay? So number 1, we're going to come into, let's say, buying those shares of stock. We're going to go to the trade tab. We're going to actually go to, let's say, Apple, okay? And if we did that, what you're now going to notice is, don't look at below there. We're going to click on the ask price. We're going to buy the shares. So in our lifetime, do we ever think we're going to have 100 shares of anything, okay? If we come in and say, look, we're going to buy 100 shares. Now, by the way, it doesn't have to be Apple. It could be a lower price dollar stock. It could be Baker Hughes, for crying out loud. That's like $37, whatever it is. We're talking about if someone buys the shares, what do they think is going to happen? They think the price is going to go up. Don't overthink it. Step 2, we're going to come down to single order. First trigger is SEQ. Now, the biggest thing is when we talk about callers, we're talking about 20 to 50 days expiration with a delta of 30 to 40 on the call and the put. You'll see that in the caller sample plan part 1. That is just saying that the call strike that we're picking is above where the investor buys the shares. Why is that? Well, doesn't it make sense that you'd want to sell the shares higher than what you bought them for? Ding, 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 ding. That's the point. Now, if we pull this up, let's say the investor says, look, I want to sell the 280. Well, if you sell the 280, that is kind of at the top end of the range of a delta 30 to 40. So how do you sell that? Well, we're going to go to where the bid price is, click right there. Now that right there, shares, call. Now remember we said, do you ever think you're going to have 100 shares in your lifetime? 2, do you ever think in your lifetime you would actually ever sell a call to try to create some income? If you said yes, okay, welcome to a cover call. Now, here's the thing, the cover call, it's the obligation to sell the shares at the strike price at the 280 from now to expiration. The problem is the risk is all the way down to 0. Now, I have a friend of mine, he's a business owner. He is so scared of the stock market. I mean, I remember talking to him at like 10:30 at night in the parking lot, and he's like, James, I know the market just is going up, but I'm just so nervous to invest. Maybe a strategy for some investors to consider right off the start with stock is allowing them to buy shares, but then defining the risk, because some people are nervous, okay? Some people, they don't know what they don't know. They want to kind of have some kind, it's kind of like bowling, right? On the left-hand side, we kind of put that little bumper pad. On the right-hand side, we kind of put the bumper pad, and it could only be so good or so bad, okay? Well, how do you buy the put? We're going to come over to that delta 30 to 40, which is the 265. And if we did that, we're going to click right on the ask price. This right here is a buy right caller. Okay, buying the shares, writing the call, and buying the put. Buy right put. Okay, so when you draw this up, now take a sheet of paper. Don't be so cool you can't do this, okay? It's not impressing anybody. And if we look at this and we draw this out and say, look, 280 is the call and the downside is 265. And we want to ask ourselves, do we get a credit or a debit? Well, we get a 540 credit if we get filled there. We actually get a 455 debit. We pay that. It looks like it's going to be about 80 cents. So we're really going to make up to 280.80. And then if we lose, we go from 273 down to 265, which is $8. But we get what? What we get is we get 80 cents back. So just with a napkin here, we can see the downside risk is 720, and the upside really there is about $780-ish. You on the same page? Okay. Now here's what we're going to do. Trade number 1, we're going to actually go in here and just buy, okay? We're going to do confirm and send. Now notice the capital outlay to buy the shares. Noted. Step 2, what we're going to do in this case, I want to make sure that we have not, I'm just making sure that we do not have any position. So these are all Novembers. The ones I'm looking at are Decembers. I just want to make sure that we don't have the opposite position here. Now what I'm going to do is for just to make sure that this gets filled, for this example, we're going to go ahead and actually put that in, and it rejected it. I'll get that actually fixed. That's what I was kind of expecting. But let me try that in the IRA for just a sec, put it back on. And I'm going to go that. Now, by the way, could we move those prices around a smidge? We could, okay? Let me go back to the IRA, see if that can get filled. Oh, there we go. Okay, it took it. Now, the caller right there, 100 shares. There's the short call. There it is right there. And then there's the put. That right there is the caller, okay? So if someone puts on a caller, they're bullish, and they're thinking that that stock could go to the upside. The biggest thing is when you look at the delta on the position, the delta down here at the bottom is 28. So it's really like owning 28 shares of stock. So forget the caller. If the stock goes up $1, the position overall is probably up 28-ish dollars. The stock goes down $1, the position probably is down $28-ish. Okay? Now, what I want to do is I want to kind of talk about that step 2. Okay? The step 2 of this, when we talk about putting on a position like a caller, what happens when you put the position on? Now, in the hundreds to thousands of examples. Now, I know you're thinking, James, when you say thousands, that's ludicrous. I've been talking about callers for 20 years, okay? Now, I'm going to tell you right now, a lot of people know what a caller is, but they don't do callers, okay? They talk about it, but they don't really show examples of it. If you're a stock trader and you sometimes realize, hey, look, and by the way, this is question number 4. Have you ever owned 100 shares of stock and said, James, I don't like the market condition. I don't like where my stock is right here. I think there's a risk of it going down. Maybe there's even an earnings coming up, and I'm concerned that the stock might fall. Has anyone ever felt that? Now, it kind of sure seems like if you're a stock investor, and by the way, it doesn't have to be stocks. Could it be a group of stocks like we talked about on Friday? The answer is yes. Okay? So now what I want to do is I want to go back to this, and the example that I want to pull from are these examples of callers that we've done in the past. Now, there's really 4 situations that tends to happen in callers. Number 1, the investor puts on a collar and the stock after 9 or 10 trading days. The reason why that statement is really important is once you put on a collar, you're waiting to kind of see what happens. If the stock goes up, you're still bullish. You can still participate to a point. There's no need to, for example, oh my gosh, if it goes up, I'm not making nothing. That's not true. Your position is probably about a 30 delta for every 100 shares of stock you have. So in situation number 1, we're talking about you put the collar on and you're waiting about, let's say, 10 days to see what happens. Can the stock break above the resistance? The reason why you probably put on the collar is you saw resistance and or the stock dropping. Number 2, the stock, you put on the collar, and this is the stock maybe prior to those 9 or 10 trading days, the stock just breaks to the upside. Number 3, the stock drops. And number 4, the stock does nothing. Okay, now let's kind of talk about situation number 1. So situation number 1, you put on the collar, you waited like those 2 weeks, and the stock, for example, you identified resistance. Let's bring up this example given, Cisco. Okay. So if I were to ask you a question, where do you see resistance? Now, I'm going to go back to this. When was it put on? That was put on the 4th. Okay. Now, why did we put the collar on? Well, we put the collar on because we thought the stock hit the target. Now, what happens sometimes when stocks hit targets? People use the target as maybe an opportunity to what? Sell. And if enough sellers come in, it pushes the price down. Now, so far, that's when the collar was put on. Down, 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 and more down. Now, so let me kind of recap. So we put the collar on in where the white oval is, okay? So after 9 or 10 days, while sitting in protection, meaning you sold the call and you bought the put, define the resistance and set a buyback for the short call 1 to 2% above resistance. Now wait, why did you just say that? Why did you just say set the buyback of the short, or consider buying the short call back 1 or 2% above resistance? Well, so we got to answer that first question. Where is the resistance? Well, if I said to you resistance is at 74.50, what is 1 to 2% above here? Well, if I did 74.50, add 1% to that, it's going to be 75.25. So now the question is, can you go into the paid money account and set the buyback? Do you know how to do that? Well, let's come into this. Let's go to monitor. Can we do that? We're going to right click on that call, create closing order. We're going to set the buyback. Now question number 3, why are we buying the call back? Well, you got to remember the diagram. Okay, the diagram, that's the long put. This is the stock. This right here, that's the short call. If we buy the call back, what are we trying to do? We're trying to release the cap. We're trying to release the obligation. Okay? That flat line, that is the short call. If we buy it back, we don't have an obligation. If we don't have an obligation, what do we got? We got shares of stock where there's an unlimited, gain to the upside. Now, so how do we do this? Okay. Now, a lot of people say, well, I don't know when to buy it back. Let's kind of practice following examples, okay? So after 9 or 10 trading days, while sitting in protection, meaning the short call and long put, consider setting the buyback. To find the resistance, set a buyback 1 to 2% above resistance. So in other words, getting out of protection is like saying it's a breakout on the stock. Go back. Getting out of protection is really a breakout on the stock. So a bearish exit, which could be a bearish protection exit is really a bullish entry, which could be a bounce setup or a breakout. So what I'm going to do is going to set that buyback. I'm going to go limit market data GTC. There it is. We're going to click on the gear right there, and we're going to say, look, if it gets above that price, so we're saying Cisco, if the stock price gets greater or equal to, what was the price? The price was 75.24. And we're saying, look, we're not going to buy the call until we get above that price, 74.25. Okay, so there it is. I rounded up to the nearest penny. Now, if we take a peek at that, let me just double check this real quick. We want to make sure that when we type that in, that this number down here shows the same. Okay, now, one of the questions we had, why are we just buying the call back? Well, because if the stock shoots to the upside or breaks resistance, there's a really good chance that the put might be worth less than 50 cents. Now, if the put is worth less than 50 cents, the investor might say, I'm not going to sell that. There's nothing really to sell, okay? And so the biggest actually think, now, wonder if the stock breaks to the upside and the put is worth more than 50 cents. They could say, look, I'm going to sell that too because there is something to sell. So that kind of becomes like, if a put's not worth a lot, why am I going to sell it? If the put still has maybe more of a value of 50 cents or higher, there is something to sell. Now, what you're now going to notice is we're going to say, buying the call back, there it is. Stock needs to get above 74.25 or higher, which is just simply a break of resistance. And now what you're going to see is we're going to send the order. Now, it says due to potentially wide markets or liquidity risk, at the time of activation, this order may be mainly substituted with the limit order and worked until filled, okay? So what this is really saying is it doesn't know what the future liquidity is going to be, and it's trying to get a better fill, okay? One thing that might be helpful is start with stocks that are liquid to begin with. Now, just real quick, number 2, right? You protected the stock position, meaning you got the shares, you sold the call, and you bought the put. The stock prior to those 9 or 10 trading days breaks out to the upside. And now you're like, I'm in a caller position and the stock is breaking to the upside. Now, why do you have this 9 or 10 day filter? If you go back and back test, if you put on a caller at a timely point, you're going to see that you're going to get a lot of false alarms to take off a caller inside, or if you put on the caller and you got a 9 or 10 day window, and if you get out of that caller, you put it on, you don't wait those 9 or 10 days, you're going to see that you're going to have a lot of false breakouts. Okay? So in this situation number 2, we're saying we put on the collar and no more than 9 or 10 days has gone by. The stock breaks out to the upside. What would the investor do with the collar? In this example, the collar is not going to be touched. In our example, the investor might consider selling a new put to try to increase the delta on the position itself, but the collar is going to stay on. Why? Because when we back test it over time, there's a good chance it might break out to the upside and maybe snap back down. If we put on a collar at a good point, like resistance, there's a good chance that resistance might hold and the stock might consolidate. Okay? So the difference between 1 and 2 is how long has it been since the collar's been put on? If the collar's been on for about 2 weeks-ish, we're going to set the buyback in our example, in the paid money count. If the collar was put on and it's only been 3 days and the stock breaks to the upside, is the paid money count going to completely abort the collar? In the paid money count, no. the paid money account could actually look to sell another put, okay? Now, what I'm going to do here is we administered to Cisco. Now, by the way, when you look at Cisco, how many more days do we have? The answer is 38. Do we need to roll the call yet? Now, we always talk about if you're selling calls or you're selling puts, could you get 50%? Can we get 50%? No. We're at 41.89. If we could get 50%, could we try to sell another call with a delta 30 to 40 again in the same month? Yes, we could look for that. We're not there yet. Okay? Now let's go to this next one, which is going to kind of give us a little difference here. Now, first off, if we see we got Uber here, and you're going to see, now let's draw it up for just a sec, okay? Where did the investor buy the shares? At 95. Draw it out so it makes sense. The cap is 100. That's what you sold the call for. And you got the put at 90. Draw it out, okay? Now, we're now going to ask ourselves the question, where's the stock now? Well, the stock now is at 93. Now, this is the side of the trade that collects time decay. So what you're now seeing in this is more like situation number 4. That situation number 4 is the stock is more flat, meaning what you bought the stock for and where the stock is, they're about the same. So in situation number 4, nothing happens, meaning there's no break of support. There's no break of resistance after 25 to 40 days. This is more rare. Could happen. The sold call premium should offset the long put loss. Is it? Well, the short call premium is up 331 and it's offsetting the long put loss. Sounds like we've done this before. After the long put expiration, set the stop or consider setting the stop on the stock. This would leave the sold call on, keeping it a covered call. Now, that's provided that the long put at a different expiration. But if these are both at the same expirations, that would mean that the short call expires worthless and the long put expires worthless if we close here, and the investor only has the shares. So if we go all the way to expiration and the stock closes in between the strikes, the short call expires worthless, the long put expires worthless, and the investor would A, have 2 options. Number 1, set the stop on the stock itself. Step 2, roll the caller. We don't show that a lot. We tend to just set the stop on the stock. Now, if we look at this, could we roll the call here? Yes, we could. So let's kind of say in this case, we got 3 days remaining. Okay, you see that there? 3 days, 3 days. Now, if we decided, hey, what I'm going to do, James, is in this case, I'm going to just exit the caller. I'm going to exit it. And I'm going to exit that caller. And what I'm going to do is I'm just going to set a stop on the stock. That's not really too bad. If I did that and I said, okay, I'm going to go confirm and send, there it is. If that fills, the only thing I have left is the shares. Could you do that? We're going to go right back to Uber, bring it up, and ask ourselves the question, where's the support? Well, if we said, James, I see that support at 91.53, and I'm going to set that stop right below there, 89.70. So how do you do that? You can come right back to the position, right click, create closing order with stop, 89.70. So could you buy a call back and sell the put? I think you could. Stop, day GTC, and just like in that situation number 4, okay? The short call expires worthless, the long put expires worthless, it would leave us with the shares. If you have the shares and there's risk all the way down to 0, the investor might say, hey, I'm going to set a stop. That's what we're doing, confirm and send. If you said, I'm not going to do that, James, I want to roll the caller, then instead of being in the November expiration, you're just going to say, look, I'm now going to go to the December, and I'm now going to actually consider selling the 97.5 and the 90, given the exact same Criteria, 20 to 50 days expiration, delta 30 to 40 on both the short call and the long put. Review the liquidity on those, the open interest, bid-ask spread, to see if those have a tight bid-ask spread. Now, what happens is when you do this over and over and over and over and over again, it's just the outcomes of the four. Does the stock break up? Does the stock, for example, remember 4 situations. You put on the trade, the stock goes bullish after 9 or 10 trading days. We talked about that. Step 2, the stock before 9 or 10 trading days. The investor might consider selling the put. Situation number 3, the stock actually is below the long put strike. The investor considers closes the entire position because the stock is below that long put strike. In situation number 4, we just talked about. We talked about the 2 avenues. What happens if they both expire worthless? You could set a stop or roll the position. This is kind of what we really historically talked about on that caller sample plan part 2. There's been many questions on it. I wanted to get to it and use our past examples. Now, Cameron May is going to be up next, okay? Remember, you can subscribe to the Trader Talks channel. You could also, for example, go to the playlist. And if we go to the playlist now, you're going to see that playlist right there. This is going to show all the prior classes. And a quick reminder that Cameron will be coming up next. And we also got Barbara coming up early this afternoon. Check her class out as well. This has been done because there's been questions on it. And so I wanted to take a class to address the questions. Thank you. And hopefully this was helpful in reviewing the material of this. Your homework is to go out and practice doing 2 of these caller sample trades. And with that said, stay tuned for Cameron May coming up next. And this has been the class on Investing Master Series. Thank you so much. Take care. Bye-bye.